Hi folks, welcome back. My name's Philip Newton. On this video what we're going to look at are some of the conditions which led to a trade entry for me on the 20th of December. Over on Facebook I actually posed a few screenshots about the trade as it was developing, but there were some factors which led into the trade itself which are a recurring and repeatable pattern and effectively could be used as a strategy condition before actually pulling the trigger on a trade in itself. It's nothing new or revolutionary, at least I don't think it's anything new or revolutionary, but it is very simply based on observation, price action behavior. Now what we need to do first is to think about quite a common interpretation which is pretty much in most textbooks, and if you again trawl any of the forums or read any of the textbooks, what you will see or read about is in reference to inside bars. And very typically what all the textbooks say and what most people will tell you is that when you see an inside bar, the side that the inside bar breaches first is typically the short-term direction. So what I know to be true and what the textbook tells me to be true are two different things. So an inside bar is a bar with a high-low range that is inside the previous bar's high-low range. So just a quick example here, at the top of this move here, we can just about see inside bar. The high-low range of this bar, just where the cursor is inside the previous bar's high-low range. Let me just highlight that previous bar. So there's the previous bar with that vertical line, and the inside bar, we've got the high-low range inside that previous bar's high-low range. So why is this important? Again, coming back to what most textbooks will tell you about inside bars, the side that the inside bar breaks is typically and often the direction of the short-term movement. And there's a lot of strategies out there that focus solely on trading the breaks of inside bars. So a common strategy might be to place a buy order and a sell order above and below that inside bar, and whichever side triggers first, the opposite order would often become the stop loss. Again, that's quite a common and basic strategy around inside bars. Again, no doubt most of you have seen that on many forums or in several textbooks, but that's essentially the philosophy. Now that's the common interpretation and use of inside bars. Now that's what the textbook tells me should happen. But what do I know actually happens? So this is where the observation in price behavior comes into play. What I know to be true is vastly different from what actually happens. So just for ease of illustration, I'm just going to place a marker. So we've got these red, these yellow blobs, if you like, on the inside bars. So what do I know to be true compared to what actually happens? The side that the inside bar breaks, let's use the same example. The side that the inside bar breaks, we'll just zoom in slightly. The side that the inside bar breaks is often the short-term direction. So we have this inside bar here. The side that the bar breaks first, if you go back through the intraday data, the high actually broke first. But what actually happened? Price reversed and eventually sold off. Let's look at another illustration over here, just where the cursor is. Inside bar, the high broke first, false break, but then the genuine direction was in the opposite direction. Another one here, just to the left of the cursor. What I know to be true once again is different from what the textbooks tell me. Inside bar, the high broke first. Again, you can scroll back and check this intraday. I'm obviously just glossing over this for speed. But the high broke first, but the genuine direction was in the opposite direction. Once again, this is contrary to what the textbooks tell me. Now there are occasions when what the textbooks tell you will happen or should happen does actually happen. So for example, we've got one here, just where the cursor is now. The side that the inside bar breaks is often the short-term direction, and that was true in this case for 2 days. This is a daily chart we're looking at. So for 2 days that was right, but once again, price reversed. There was a few comments on the Facebook thread as well about, you know, why this might occur. The trend was down, for example, so it's fairly safe to assume that the continuation would be down. Well, let's just take, I can just draw on this rough trend line here. Let's just take this next one as an illustration of it doesn't matter what the trend is. So we've looked at these 1, 2, 3. Trend is down. So you would assume that when price breaks the low of that inside bar, the movement would be to the downside. But look what happens once again. What I know to be true is vastly different from what the textbooks tell me. The textbooks, as far as I'm concerned, these days are wrong. It might have been true 30, 40, 50, 60 plus years ago when that original observation was made, but the dynamics of the market constantly change and evolve. So again, we have price moving downwards, quite a nice trend if you like, in the short term. The low of the inside bar is breached. What I know to be true is that is often a false direction, and the genuine direction is in the opposite direction. Once again, we have another inside bar. The high of that bar is breached. The textbooks tell me that the direction should then continue upwards in the short term. But what I know to be true is that is often a false direction, a false break. And the genuine direction was in the opposite direction. So it's a very simple observation, and it really all revolves around comparing what I know to be true to what the textbooks tell me to be true. And again, the inside bar, that, for example here, the low or the high of the inside bar might break first, and that might genuinely be the genuine movement. I mean, this is an example of where the textbook is absolutely bang on, and a bloody good move came out of it. You know, the high of that inside cursor was not breached first, and then the resulting move was to the downside. But if we look at all the times that this actually occurs, the side that the inside bar breaks, very often, the majority of the time, is a false break. And that, in my view, in my observations, is a more common occurrence to happen than what the textbooks have now told me. So that's the principle, that's the philosophy. It's a very simple concept. You will see it on pretty much every time frame. And this really is the philosophy that led into me thinking, oh well, I've got a short trade on the pound, I've got a short trade set up on the euro. So if we look at the setup itself, let's just go over to the lower time frames on the pound against the dollar. What we have here is the 60-minute chart now, and I've got solid red lines which indicate the current day's high-low range. So what we can see at a glance is this is one day, obviously, and the next day here, the high-low range is inside the previous day's high-low range. So what we have here is, again, the inside bar. Now, I know we have, just where the cursor is here, another inside bar there, but we've actually got a shooting star inside bar, which is a slightly different interpretation. So while there is an inside bar there, there are other factors that would contribute to whether you would trade the potential false break. So in this just a little bit of a sidebar here, we've got a shooting bar inside bar combination, or a narrow ranging bar. That is generally very often a reversal indication, and price will quite typically opposite direction. So we've got price moving up here, shooting star, inside bar combination, and price very often will sell off. You know, that is a very good and very stereotypical textbook setup. It's one of the few ones that I actually do agree with. So a little bit of a sidebar in case you're wondering why it didn't happen on this inside bar here. Anyway, so we've got inside bar, we've got a nice steady movement down, trending movement, inside bar or inside day. And then what we have, if we just scroll through the chart, is the breach of that previous day's high, just there. So we've got the breach of that previous day's high. There was very minimal follow through as well. So we've got a false break of the inside bar. Now if we also think about what's actually going on behind the scenes, if you were an institutional trader or working for one of the larger banks and you have a client that needs X amounts of currency transferring from pounds to dollars or dollars to pounds, you need liquidity. You need to be able to fulfill that order at the best price. If you got an order land on your desk that you've then got to fulfill to exchange the currency from one to the other, you need to look for liquidity. If you were to basically just dump that order on the markets, you're not going to be doing your client any favours. So we just put ourselves in the mindset of what's going on with this inside bar for a moment. Because this is a common setup, because this is in pretty much every textbook, because most new traders want a simple life and they don't want to work hard at trying to find trading opportunities, they're going to go for the easiest option, which is often the wrong option. And if everyone is doing this, then it's going to provide the big dogs with liquidity that they need. The textbook says place a buy order above, a sell order below, and basically close your eyes and hope for the best. That's what the textbooks tell us. You pay stupid amounts for these textbooks these days, the trading textbooks, $60, $70, $80, $90, and however many thousands to buy it as a part of some crappy trading course. And it just tells you, place a buy order above, place a sell order below, close your eyes, hope for the best. Now, this is providing liquidity, order fulfillments above and below that inside bar. So if that order, if you were an institutional trader, landed on your desk and you've got an order to fill, you're going to look for liquidity to provide your client with the best price. Prices can be ran up to above the high of that inside bar. There is a block order of buys above that inside bar, because that's where the textbook tells every retail trader to place their orders. So the institutional trader has now got liquidity. So all those retail traders, and I would include a lot of hedge funds in that retail trader bracket. So prices get run up above the high of that inside bar. Liquidity is fulfilled. Who's on the other side of that order? It's the institutional trader. They've got an order to fill. Liquidity has been provided by the retail traders. So they can now get the best price for their clients. Anyway, that's my conspiracy theory about order placement and effectively stop running is how it's commonly referred to. But essentially, it just literally is based on observation. The textbook is often, or the textbook interpretation is often manipulated. And this is what catches a lot of new traders out. If everyone knows to place a buy order above and a sell order below that inside bar, because the textbook tells you to do it, rather than base your strategy on observation. Alright, well that's what the textbook says, but what do I know to be true? And again, what I know to be true, as we saw on the daily chart, the majority of the time, the inside bar breaks is often, and more commonly, a false break. And that very simply, folks, is what led into the short trade on the pound dollar. Again, very simply, it was a false break, but thinking about what goes on, it's the complete opposite to what the textbooks tell you should happen with this particular bar formation. Now if we just drill down a little bit deeper, we've also got the same condition within the larger daily condition. Multiple inside bars. Multiple inside bars. The side that the inside bar breaks is often a false direction. That's what we know to be true. That's the most common thing to happen. Now this is a little bit of a double whammy because we have it on the 60-minute time frame and we've got the condition on the daily time frame, and effectively you are trading a false break or a reversal type setup. But again, it's a very common thing to happen, very common. But that's it, folks. That's the primary condition that led into it. We had the same pattern on the 60-minute chart, the same pattern on the daily minute chart. Basically a double or a single pattern but on a dual time frame. It was a nice condition, and that was what led into the short on the pound dollar. All we have to do is think contrary to what the textbooks tell us. And again, once again, just to recap, I've said it a lot of times already, but I really want to drive the point home. What do I know to be true compared to what the textbooks tell me should be true? The textbooks tell me buy above, sell below the inside bar, close your eyes, hope for the best. The side that the inside bar breaks is the short-term direction. And if you'd asked me this 5 years ago, I would have said, yeah, that's true. That does happen. But there's been a significant shift in how these inside bars are often treated. And what's more common these days is the side that the inside bar breaks is most commonly a false direction. So there's been a shift in the interpretation of how you can trade an inside bar. So don't believe everything you see, folks. Do your own due diligence, do your testing, and again, compare what you know to be true with what the textbooks tell you should happen. It might have been, well, 5 years ago, this philosophy was quite correct. You could get away with placing a buy order and a sell order above and below an inside bar, or even the Asian range. In the same way, place a buy order above, a sell order below. It's called a bracket range breakout, but it's a bracket type order, buy order above, sell order below. You could get away with that 5 years ago. Today you can't get away with it because the market has changed. So compare what you know to be true, do your research, observe price action, and compare that with what the textbook tells you to be true. If they both line up, then you can trade it. If they don't, you've just adapted to market conditions. So this is basically all about adapting to market conditions. Compare what you know to be true with what the textbooks tell you should happen. And this is what I know to be true. The side that the inside bar breaks is most commonly a false break, and the genuine direction will be in the opposite, or be the break of the opposite side of the bar, as highlighted on the pound dollar. That's it, folks. I think I've rambled on far too much, but nevertheless, that's the philosophy behind it. It's a very simple price action observation. I hope you can utilize it in your own trading. Let me know how you get on with it.